657 million ounces. That is the total paper claim sitting on top of the COMEX silver market right now. And on the other side of that equation, the real, physical, deliverable metal actually sitting in those vaults, 87 million ounces. I am not going to tell you what to think about that number yet. I just want you to hold it, because by the time we are done today, you are going to see exactly why that gap is the most important structural story in silver right now, and why almost nobody in the mainstream financial press is connecting the dots on it. My name is John, 15 years in FX and commodity markets before I ever picked up a camera. I left that world because I believed the people watching their savings from home deserved the same level of analysis the institutions were getting. That is what we do here at Currency Insider. No doom, no pumping, no dealer sponsorships. Everything I show you today comes from publicly available sources, and I will name every single one as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are building here week by week is a framework for reading these markets that most retail investors never get access to. Here is exactly what you are walking away with today, what 7x paper to physical leverage actually means in practice, and when it becomes a problem, why the $10 Shanghai premium is developing right now, and what it is telling us about Asian physical demand, how Western macro traders are reading this completely differently from Eastern physical buyers, my one specific call for this week on record, and a genuine bull and bear case with equal weight on both sides. Last week I put one specific call on record. I told you to watch COMEX registered silver inventory, specifically whether it dropped below 85 million ounces while the Shanghai premium held above $8. Here is the honest answer. Registered inventory has held near 87.2 million ounces and has not broken below that 85 million threshold yet. The call has not triggered. Now here is why I still think the setup is valid, and here is what would tell me I am wrong. The Shanghai premium has not collapsed. It is still sitting near 1051 above COMEX benchmarks. That means the physical pressure from Asia has not gone away. What has not happened yet is the Western delivery demand that would force inventory lower. If registered inventory starts climbing back toward 95 million ounces over the next 2 weeks, I will tell you plainly that the setup has faded. That is the exit condition. That is how this works. No edits, no excuses. Let me show you where we are right now in the market. Spot silver is currently near 88.10 per ounce. Gold is near 5,270 $. Both metals are in what looks like a consolidation phase after a volatile first quarter. But here is the thing about consolidation. The price going sideways does not mean nothing is happening. Sometimes the most important things happen underneath a flat price. And right now, underneath silver's price, the structural data is anything but quiet. Drop in the comments right now. When you look at silver consolidating near $88, does that read to you as a pause before a move higher, or does it feel like distribution? I genuinely want to know what the people watching this channel are seeing from where they sit. Let me walk you through the structure of what is actually happening inside the COMEX system, because this is the part that gets glossed over in most coverage, and it is the part that matters most. COMEX registered silver inventory currently stands near 87.2 million ounces. That is the metal that is formally available and eligible for delivery against futures contracts. On the other side of the ledger, open interest in silver futures currently represents approximately 657.5 million ounces of paper claims. That is a ratio of roughly 7.5 to 1. For every single ounce of physical silver that COMEX has available to deliver right now, there are 7.5 ounces worth of promises sitting on top of it. Now, before anyone starts reaching for alarm bells, I want to be precise about what this means and what it does not mean. This system works most of the time because the vast majority of futures contracts never result in physical delivery. Traders roll positions, they cash settle, they exit before the delivery window opens. The leverage is structural, and it has existed in various forms for decades. The CME warehouse report is where I pulled this data, and the number is not new, but the context around it right now is what makes it worth paying close attention to. Here's the analogy I want you to carry. Think of a busy train station with 100 seats on the next train. The station sells 750 tickets. On a normal day that works fine, most people buy a ticket and then decide not to travel, or they take a different train. But the moment there is a rail strike announced and everyone suddenly needs to be on that specific train at the same time, 750 tickets and 100 seats becomes a very different problem very quickly. COMEX is that train station, 87 million ounces of seats, 657 million ounces of tickets. The question is never whether the system is leveraged. It always is. The question is what changes the behavior of the ticket holders. Hold that thought, because in about 8 minutes, the positioning data is going to show you exactly what the ticket holders are doing right now, and it is not what you might expect. Now here is the layer that makes this week's data genuinely interesting. That 7.5 to 1 leverage ratio is not developing in isolation. It is developing at exactly the same time as a significant physical premium in Asia. Shanghai silver is currently pricing near $98.61 per ounce. COMEX silver is near $88.10. That is a premium of $10.51, roughly 11 to 12% above New York benchmarks. And I want to be careful here because a Shanghai premium does not automatically mean a squeeze is imminent. Premiums reflect local taxes, import financing costs, market microstructure, and seasonal demand patterns that can have nothing to do with a global supply crisis. I am not going to tell you it means more than it does. But here is what makes this premium structurally significant rather than just a local pricing quirk. The Silver Institute's demand data shows that Asian industrial consumption, particularly solar panel manufacturing, which requires silver for photovoltaic cell connectors, has been absorbing a growing share of annual mine supply. Bullion accumulation by Asian investors and institutions has also been running at elevated levels. So the premium is not just a trading artifact, it is reflecting genuine end-use demand for physical metal at prices that Western futures markets have not yet fully priced in. Think of it like two petrol stations on opposite sides of a motorway. One side is charging 20 pence more per liter than the other. In the short term, that gap exists because of local conditions. But if enough drivers start crossing the motorway to fill up on the cheaper side runs low, and eventually the price has to adjust. That is the arbitrage dynamic that makes the Shanghai premium worth watching. If you know someone who has been following silver this week and trying to understand why the price feels disconnected from the news, share this video with them right now. This is exactly the kind of structural breakdown that gets lost in the headline noise, and the people who need it most are usually not searching for it. Stop. Before I go any further, I need to show you something that genuinely complicates the picture I just painted, and I think it would be dishonest not to put it in front of you. The US dollar index is currently holding near 99. The US 10-year Treasury yield is sitting near 4.06%. Those two numbers are a real headwind for silver. When real yields stay elevated, the opportunity cost of holding a non-yielding asset like silver goes up. And the CFTC commitment of traders data shows that Western managed money, the hedge funds, the professional futures traders, is currently positioned with macro in mind, not physical supply dynamics. They are watching yields, they are watching the dollar. They are not sitting at a desk in New York thinking about what Asian solar manufacturers are paying for silver in Shanghai. That institutional divide between how Eastern physical buyers and Western futures traders are reading the same metal is the central tension in this market right now. Now let me bring in the macro and geopolitical context, because it connects directly to both sides of that tension. The dollar holding near 99 is partly a reflection of geopolitical uncertainty tied to Middle Eastern tensions, including the fragile state of the US-Iran situation. Geopolitical stress of this kind typically creates two simultaneous effects in precious metals: short-term dollar demand from institutional safety flows, and increased physical accumulation in Asia and the Middle East from investors who do not trust paper instruments the way Western markets do. When I look at World Gold Council data on central bank reserve allocation, what I see is a multi-year structural shift that is moving slowly but consistently. These are not traders reacting to a headline. When a central bank moves reserves into gold, that is a decision made over months, signed off at the highest institutional levels, and executed over quarters. The direction of that shift has been consistently away from pure dollar holdings and toward gold for several years. And that matters for silver indirectly, because gold strength driven by central bank demand creates a macro environment where silver's monetary premium also tends to expand over time. On the UK side, the London Bullion Market Association vault data continues to show London as the world's primary physical gold settlement hub, and LBMA activity reflects the same institutional appetite we are seeing in Asia. For British investors holding metal inside a SIPP, the Bank of England reserve posture and LBMA settlement volumes are worth monitoring as a leading indicator of where institutional weight of money is actually moving, not where the headlines say it is moving. De-dollarization is not a Tuesday event. It is a decade-long structural process. But the direction of travel is documented, and the current dollar index level near 99 is a data point in that larger story, not a standalone signal to act on. The industrial demand story for silver is one that I think gets underappreciated even by serious precious metals investors, and it changes the supply-demand picture in ways that matter beyond just the monetary angle. The Silver Institute's latest demand data shows industrial consumption absorbing a significant and growing share of annual mine supply. Solar panel manufacturing requires silver for photovoltaic cell connections at a scale that cannot easily be substituted with cheaper materials. The conductivity requirements are specific, and silver is currently the best available solution at commercial scale. AI infrastructure, the physical servers, the high-performance connectors, the cooling systems, uses silver in ways that are not widely discussed, but are real and quantifiable. In the UK, the push toward North Sea energy transition and expanded solar capacity is adding industrial silver demand that simply did not exist at this scale 5 years ago. I am not going to give you a precise ounce per megawatt figure because that would be false precision, and you deserve better than that. What the Silver Institute data shows is the direction, and that direction has not reversed. Silver is not like oil where you can watch it burning in an engine. It is dispersed in tiny amounts across enormous industrial systems, electronics, medical devices, solar panels, defense components. Getting it back out once it is in those systems is complicated and expensive. Think of it like the electrical wiring inside every house in Britain. You know it is there, you know roughly how much copper is in it. But extracting and recycling it perfectly from millions of homes is a completely different challenge from mining new copper. Silver has the same embedded and dispersed problem at industrial scale. If you have stayed with me this far, what comes next is the part that actually changes how you read this market going forward, because this is where the framework replaces the noise. All right, the 3 lanes framework. This is how I separate what matters from what is just movement. Lane 1, the paper market, the blue lane. COMEX registered inventory near 87.2 million ounces against 657.5 million ounces of paper claims. Coverage ratio near 13%. CFTC commitment of traders data showing Western managed money focused on macro, yields and dollar, not on physical delivery dynamics. The paper lane is structurally leveraged, but not yet under delivery stress. Lane 2, the physical market, the silver lane. Shanghai pricing silver at an 11 to 12% premium to COMEX. Royal Mint silver sales in the UK, continuing to reflect steady retail demand from British investors, particularly those accumulating physical metal inside CIPPs. COMEX registered inventory holding but not growing. Flat is not the same as comfortable when paper claims are this elevated. Lane 3, the macro lane, the gold lane. Dollar index near 99, sitting below the psychologically significant 100 level. 10-year Treasury yield near 4.06%. Elevated but not accelerating higher. Gold holding above $5,200 with World Gold Council Central Bank buying data providing a structural floor. John here, FX Insider, and in 15 years watching currency and commodity markets, the specific combination I am looking at across these 3 lanes right now is one I have seen precede significant moves before. Not always, not guaranteed, but the pattern of flat to tightening physical inventory, elevated paper leverage, and an expanding geographic premium in Asia. That combination has historically been a leading indicator worth taking seriously. I am not saying the move is here today. I am saying the setup is developing, and the 3 lanes are beginning to point in the same direction. When paper is leveraged, physical is at a premium, and macro is softening on the dollar. The historical pattern has been that something has to give. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One specific metric. One specific threshold, and I will be back next video to tell you exactly what happened. I am watching the COMEX silver registered inventory number from the CME warehouse report. Specifically, I want to see whether it breaks below 85 million ounces this week. That is the threshold. If registered inventory drops below 85 million ounces, while the Shanghai premium holds above $8 per ounce, that is the combination that historically begins to attract institutional attention toward delivery risk in a meaningful way. If inventory holds flat or rises, the physical pressure is being absorbed without triggering that dynamic, and I will tell you that plainly next video, regardless of which way it goes. This is my one call for the week. John, FX Insider. On record right now. I will be back next video with the exact result. No edits, no excuses. That is the only way this works, and it is the only way you should trust anyone giving you market analysis. Now here is where I want to be completely straight with you, because this is the part where most channels pick a side and start selling you a story. I am not doing that. Here's what needs to happen for the optimistic picture to develop. The Shanghai premium needs to persist or expand beyond $10. If Asian physical buyers keep paying that kind of premium over COMEX, arbitrage logic eventually kicks in. traders will begin moving physical metal westward out of COMEX vaults to capture the spread. That reduces registered inventory further. If inventory falls below 85 million ounces while open interest stays elevated, the coverage ratio compresses and delivery risk enters the institutional conversation in a real way. Futures markets would then face pressure to reprice higher to close the arbitrage gap. That is the bull path, and it is a mechanically coherent one. Now here is what needs to happen for the cautious picture instead. If Treasury yields push back above 4.2%, Western futures traders get a fresh macro reason to reduce silver longs. That selling pressure can narrow the Shanghai premium quickly, not because Asian demand disappears, but because COMEX paper prices adjust upward to meet Shanghai prices rather than Shanghai prices falling to meet COMEX. A dollar recovery back above 101 reinforces this path and gives managed money another reason to stay on the sidelines. Both outcomes are genuinely possible right now. The data does not hand you a verdict. It hands you conditions to monitor. Your job is not to pick a side and emotionally commit to it. Your job is to watch which set of conditions is actually developing in real time. The market will tell you what is happening. You just need to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean every word of it, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach the people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers in the comments, not just a thumbs up. First question. When you look at the 7.5 to 1 paper to physical ratio on COMEX, does that change how you think about the silver you hold in futures or ETF form versus physical metal in hand? Second question. Are you currently seeing any change in physical silver premiums at your local dealer or online, UK or US, compared to 3 months ago? Drop both answers below. The comment section here is a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are going deep into how to read the CFTC Commitment of Traders report yourself. I am going to show you exactly what managed money positioning looks like when a market is about to move, and that is a skill that will serve you in every precious metal cycle going forward. And if someone in your life is watching their silver position right now and feeling uncertain about what the structure of this market actually means, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.